Hey guys, Freaky Finance here. Merry Christmas, Happy Holidays, wherever you guys are. Today is going to be a different video, just going to be a year-end video. Kind of like on my overall thoughts and then going through current positions, just all of them, just to kind of level set things. I like to look at this video specifically during the year to see kind of what's happening relative to what I thought going into it. Ultimately change course or recommend whatever I'm currently doing, if there's any changes that I need to be taking. So this is kind of a video more for me. This year you can see largely the Magnificent 7 were very magnificent. Part of that, I think we talked about mean reversion a few times. It's largely mean reversion. So last year, I just snipped my old video from last year and you can see the Magnificent 7 weren't that magnificent last year. So we've seen a pretty big recovery, like Tesla down 65. Now it's up 105, right? Amazon down 40, up 80 now. So it's kind of recovered what it lost last year. So a lot of these big numbers are really a mean reversion recovery. So what I like to do here is kind of like, what's it kind of telling me now? So part of that is passive funds going into the large caps. We've seen large caps outperform the small caps this whole year, and the small caps were actually not performing well last year either. So we know there's relative value in small caps, probably relative value in China. But you also got to look for ones that are just down, but are decelerating to the downside. So we have AT&T still down on a year, and they were actually down in the prior year as well with Verizon. Same thing with the PayPal, down last year, killed last year, and then down again slightly this year, another 11. So that's kind of like what I look for, and then I kind of be like, okay, what's going on structurally with this company? Is it structurally worse? If so, am I getting a good price to take that risk that it eventually recovers, kind of thing, right? That's kind of how my thought process works. And then I also look at sectors in general. So we've seen tech on fire again. Part of that, again, is the mean recovery because tech was getting killed last year, especially software. So we've seen software bottom, and I think that especially in small cap software, we should still be able to get some upside. We've seen energy give up some of the gains that it's got. Part of that's commodity driven. Part of that was, again, mean reversion the other way last year, right? The XCOM was up 80% last year, so giving back 10 this year is not a real mean reversion. So there could be more pain in energy, especially if they're still chasing higher prices and we have higher inventory because weather's been warmer so far for this year. So that's kind of just how I think about things. And there's things that are structural, like say a Pfizer, which is that killed both years, partially because of the vaccine, as well as other things. And they're getting longer in their patent life, stuff like that, where it could be more structured, where I'm not as interested to take a shot. And then things that have gotten out of favor this year. So consumer defenses have gotten out of favor. Utilities have gotten out of favor. So stuff, more defensive stuff has gotten out of favor relatively. So that kind of tells me where I should probably go. And a part of that could just be dividend driven, right? Because rates have been so high, the dividends that these defensive are paying aren't as attractive. And then eventually that will mean revert as rates start heading lower again over time. So that's just kind of what I think. Let's jump into it. In Canada, we've pretty much, in my mind, we've been in a recession. It's been rolling in different sectors at different times. But in terms of real per capita, like control for the population growth, immigration specifically, Canada's been in a recession very clearly for more than a year now. But the blue bar here, technically wouldn't, because you need 2 quarters worth. One of the things that's holding us up is the C in GDP, so the consumption has been getting inflated by immigration. And then you also have government spending, which is also very high still. The governments, the world continue to spend more than they should, and which is adding to inflation, but it's also helping to keep the economy strong. So that rate of change either slows or decels. Should see more weakness. Alternatively, it could pick up again. It's hard to forecast government policy, but as long as you get the rate of change, it's worthwhile. And I think a part of that, the stocks I picked up for in Canada, we're seeing valuations get cheaper. Part of that's the growth is weaker in Canada. So it's already priced in more weakness, I'd say. It doesn't mean you can't print more weakness. It just means that things are finally starting to get interesting again, especially in certain sectors. And we'll go into them in a second. In terms of what I like to look for, like unemployment's always very leggy. And usually by the time you see unemployment peak, usually you're already past the cheapest prices you would have got for that recessionary cycle. So we are seeing unemployment in Canada go up. It's gone from 5% to 5.7, I think, right now. So it has been going up since April last year, so April 2023. But what I like to see here is the length that it takes someone to find a job, and we've seen that just increase very consistently, especially over the more recent months. So that tells me whether or not they want to report numbers accurately. I can tell people are struggling to find jobs more than they have even just in August, right, relative to November. So that tells me things are getting worse quicker. And so that should also mean unemployment continues to at least directionally get worse in Canada, which should lead to more recessionary pressures and hopefully more deals. Though the market's good at sniffing these things out ahead of time as well. So usually around this time is when I start getting excited. Unfortunately, the markets have moved up from October lows, where I was starting to snip a couple of nice buys from the banks and utilities in Canada that we were seeing, and I'm hoping to get some more of those, but we might not. It might just be riskier ones that correct quicker. The defensive ones stay because they've already been cheap for 2 years now. So that's kind of how I'm thinking it. It's a little bit convoluted, but basically here it's just an easy way you can see people that are looking for jobs in yellow, 27 weeks or more, so more than half a year, is starting to pick up. So people are now being unemployed for more than half a year and starting to show up more. And even the move up from 5 to 13 weeks, this blue line, to this one, just month over month, you can see that more people have moved to 14 to 26 weeks of unemployment. So that it's getting worse, is what I'm trying to articulate. And then in terms of inflation, also, I think January will still be the higher for longer thing, and maybe February, but then it'll just continue to decline. One of the reasons Canada's actually stayed as high as it has is because of the mortgage interest cost itself. The fact that they've raised rates as quickly as they have has also caused inflation, is how it reports in Canada. And I like this one that RBC does. It basically says of the 3.1% inflation we still have, 0.85% of that is mortgage interest cost. That will still stay high for a bit, but it will slowly, just in terms of rate of change, it has to come back down because rates have stopped going up. So even if they hold rates, this will, no matter what, start coming back down, and that will drive the rest of them down, or the overall percent down. It should anyway, unless groceries or gas reaccelerate. You never actually really know. You just have to make educated guesses over time. So let's jump into actual positions. So we've kind of had a service skew for a while, and I've tried to take shots into goods, and I expect that to continue. Services is just easier in my mind because they've never, like, here's an easy example. Our Canada just put up the best numbers they ever have, right? And it's still half off 2019, right? That's a simple way to word it. So that's another one where I keep trying to chip in when it gets under 17 or under 18. And that's when I'll look at to continue. Now, on the negative, you have higher pilot wages. On the positive, you might have cheaper fuel prices still. So, and then you have higher wages over time, or higher prices over time, which they still have to catch up to, and higher capacity, which, for example, the APAC region, so the Asia Pacific region, has just failed to recover, especially the traffic between China and Canada, which used to be actually fairly strong before COVID. It hasn't recovered at all. So that's just an easy way. I think basically you're getting a business that's better than 2019 levels, but you're getting it half off. That doesn't mean next year might be bad because it has hard comps from this year. It just means that over time I expect that to work out. And I'm hoping for a better price. A lot of these I'm hoping for better prices to add to. Usually I don't have so many green. Usually it's more mixed, right? I might be right 60% of the time, but this time, especially with the last 2 months of just almost steady green since October, it just makes the deals not look as good. Anyway, organic gold, I talked about that one. That's a fun one. I just keep picking up as I'll write it up, and then I'll sell it off, and then we'll do a raise. I'll try to, I'm basically timing the raise cycle. That I did a video close enough to this video that I don't need to go into that one. Capstone Copper, I also did a video on this one. This is one that's just slowly playing out over time. Just has a good production cadence into what I think will be a copper scarcity cycle in 2028, 2029. So it's a little bit farther out play, and I try to get in, basically I try to add into the miners when the fuel prices get cheaper. Just because I think the margins expand, and I mean, if copper goes up, great. But ideally I want it to pull back, and then I can get a better entry. Though it's been pretty resilient, and the on-hand inventory for copper has been very, very low. So maybe I never get that super easy shot, but I've been trying to pick shots as it gets cheaper now and then. Same thing I could say for Hudbay and Ivanhoe. Again, it's just getting that production cycle of copper into what I think will be a time of scarce copper, the back half of this decade. What else is there? So software, so this is small cap Canada. Small cap Canada still has lots of opportunities. CTS is just an easy software. We've already seen it bottom. That is, the weakening year over year has bottomed out. So we should start seeing it. That's what happens. The market starts front running this. The business hasn't improved that much. It's just all of a sudden the price is up 50%, right? Part of it's because it probably never should have got down that much, but it's hard to time these things because people are very bipolar with what they're willing to pay and when they're willing to sell. E-split, so that's just the Enbridge. That's just a cover call on Enbridge. It just pays 12% a year, and I think it's probably underpriced by at least 20%. So it's just an easy one there in Canada. Hamilton's just a fun one. I've just started to position in. It's basically the banks in Canada, the financials, and again, it's a covered call. Just another way to get dividend income. And then I just roll it into other things as they get cheaper over time, hopefully. What else is there? London, again, other copper miner play. Ontario is just an event-driven play that I'm trying to play. We'll see how that goes, but that's just a legal thing. REITs I talked about before a few times. That's one where the business, I mean, it's still going to put up in a crap year. It's going to put up probably 40 million in EBITDA, even if it was 20 million in EBITDA or 10 million in EBITDA. Basically you got $100 million in cash on the balance sheet. The company's only worth 150 million. So basically the market's saying it's worth 50 million, and it could generate between 20 to 40 million in a bad year. So it's an easier, just really a value play. But I do expect the consumer to still be weak, and it has been so far for most of retail. So that doesn't necessarily mean I think it's going to inflect. I just know the value is very, at some point, as long as REITs makes it, they'll probably rate higher at some point. Ticks, so that's just a Telecom spin-off. It's just super strong growth rate historically. Again, it's a bottoming play on this in two different accounts. We'll see it as I go down. It's just a software play that's bottoming. In my mind, it's similar to CTS. What else is there? So we got Tidewater. I did a video on this one. This one just basically in November, their EBITDA went from 50 million. It should run rate to about 150 million year over year. So we should start seeing that report partially in the next quarter, and then we should see the run rate easy comps for the next year. So that's just an easy rate of change positive on a very cheap valuation. And I constantly check the credits on BC's website to make sure that margin is still there, and so far so good. So that's just an easier one in my mind, which I'm slowly allocating to. It's very thinly traded. Airbnb, I did that video a long time ago. Business is still performing. I look for shots to add. It's just harder to add, and especially because the ADR growth has slowed. So in terms of rate of change, it might be. I was kind of hoping for more of a pullback, but so far, multiples in tech land have expanded, especially on the software side, which Airbnb is sitting in. So, but the business itself is amazing. The scale is amazing, and over time, I think that business is just amazing. Avalta, so that's due free. This is one I've been in for a while. I've been trading around it. The business itself has performed. It's been recovering. Just the share price hasn't, which is fine. Over time, I expect that to also come back to its normal traded range. They were able to pick up a couple cheap buys during the pandemic at relatively cheap valuations, and I expect them to come out ahead in the long run. Azure Power, that's just a fun one. I saw the solar play in India a long time ago, and it finally it delisted, and it hit like a penny for some reason. It went from like $10 to a penny. So I started buying token position. Basically every now and then you see something that's just too weird. And this is a fun one. In hindsight, I could have put more in. I've already sold most of it, but I just want this one here because I want to look at it, try to see if I can replicate it in the future. But that was just a funny one where it's like, really? Just because it's delisted? It was always risky, and it was always a bad business. But the fact that it went down so much so quickly was just interesting. Build-A-Bear, we just did that one. Don't go into that one. Carnival, just basically we've seen carnivals just or cruise ships in general get decimated during COVID, and that's just more of a reopening play that's still reopening. Still actually, again, doing better than 2019 levels, but trading cheaper than 2019 prices in terms of valuation. Very similar, like a lot of reopening plays have reopened, but the valuations haven't come back, even though the businesses are putting up better numbers than they ever have before, or close to them. Celsius, that's a fun one. So this is one, it's a growth year name. It's definitely not a value play. It's basically Pepsi put them up on distribution. But the cool thing, instead of just the revenue growth, which is what everyone focuses on, which is high, it's triple digits, over 100% a year. The reason why I like Celsius is because the SGA is just done so well under Pepsi's distribution model. So we've seen scale across every line item for Celsius ever since Pepsi's jumped on them. So I expect that to continue as they push internationally. So I just think that's a fun one over time. It is relatively steep valuation, but I mean, Monster's also steep valuation, and they're beating the pants out of Monster right now, and Red Bull. So it's an interesting one. Chewy is a fun one. Kind of a sad one because my dog's name was Chewy, and he passed away in December. So I picked up some shares of Chewy. This one's starting. It's a harder one to scale because freight. Obviously, dog food's heavy, or can be. So that's a harder business model. But they're starting to show scale. The auto shipping feature is working, and now they're starting to cross-sell other things such as vet services and medication. We should start seeing margins expand over time as well there. Children's Place, I just did a video on that one. Again, some of these retailers actually haven't bottomed yet, I should say they look like they are bottoming, but they don't look great yet. So, but usually the market will front run that. People will start taking speculative bets, kind of like me, before they actually start getting better. Like, I don't know why City Trends is up as much as it is relative to where I was able to get in during we did a video on City Trends, right? And it got pretty cheap. Again, the market is front running a rate of change, so things are stop getting worse is good enough in the current environment, or at least that's what it looks like at the time of this video. Cloudflare, so that's net. It's very basically, this is my easier software play on security, cybersecurity. I just think they have the biggest reach and an easy platform to take revenue whenever they want. Oversimplify. Maybe one day I'll go into net. It's not as complicated as you think, but it's an interesting business. I've wrote it a few times. Crocs is just shoes, very high margin, relatively expensive, I'd say. So I'm trying to get cheaper prices. It's got cheaper, but unfortunately it keeps bouncing. They have a couple decent value unlocks that I'll probably do a video on at some point. Them and designer brands also got cheaper around the same time. Yeah, most footwear orientated things. Maybe I'll do a video on DBI at some point. Funko, I just did a video on. Hasbro, same thing. You can see quite a bit of these are actually retail goods plays. And again, that's because I think they've bottomed, or they have been bottoming, and I'm getting good deals relative to their long-term averages. Again, I'm buying these things as I say the economy is getting worse, right? So I am expecting them all to rally, but again, when everyone thinks the economy is getting worse, chances are I'm getting a good deal. And historically speaking, all those price points that I've been picking these up are probably going to be good in the long run. I was just kind of surprised how quickly they've rallied in the short run, arguably before they should have. Linning's just one I just picked up this morning. I just saw that it was getting pretty cheap. It's basically, people call it the Nike of China. I think China is going to be more and more nationalistic, and I think it's going to keep supporting its local companies. I also, because China's been decimated for over 3 years now, I'm also starting to try to allocate more to China. I got burnt once trying to do that, and I'm trying to get into it again. Mobileye, I just view this one as an easier way to play autonomous driving. It's not Tesla. I just think their CEO is better, and I think they do have a pretty strong moat in terms of the mapping, and I think that's just going to enable them to partner with all the OEMs that aren't Tesla, and basically allow them to compete autonomously in the future. And I expect them to do quite well, but again, that's a speculative play. New Fortress, basically this is just a capex play on LNG. So they spent a fortune building out LNG export areas in the Gulf and other places. Maybe I'll do a video on this one at some point. It's another interesting one. But basically, I just think LNG is going to be the future, especially with how much prices are getting disconnected with the push to renewables in different continents. That's just a way to play it. It's similar to kind of like Enbridge and Trap and stuff like that, is where they're allocating resources are on the LNG side. And I think that's just the easiest way, right? As coal slowly continues to fade away, LNG will be here to play. And basically, the hub hopping between the different continents is going to be through LNG. And so I think LNG infrastructure providers will be the easier value winners over time. Rick Hospitality, I think I did a video on that one. It's CEO's, on the latest call, sounds like he's doing what I want him to do, which is basically allocating more resources to the stripper business and less to the bombshells business. Or at least they're going to think of a different way to get capital for the bombshell business that won't be dilutive to the core hospitality nightclub business. Real, we won't really get into that one right now. I'm not sure if I'll hold it forever. I was just getting too cheap. It went from $20 to $1, right? Some of these retailers have just been taken to the woodshed. And so this is one where it actually has a decent revenue growth. It's still not great economics in terms of a business model, but it has the growth to get there. It's just one of those riskier plays. So maybe I'll do a video on it one time. Spirit, I own this in 2 different accounts. I did a video on this a long time ago. I got destroyed on it. Basically here now you're just basically playing the merger play, which you should hear about within a month anyway. JetBlue's buying them for $32 and it's currently trading at 16 or whatever it is. So I actually got down to 8 during the trial, which is fun. 10 cents. So that's my other larger China play still, and I'm slowly adding to it as I can. Their business is cheaper than 2019 levels again, but the business is probably twice as profitable. Tencent has a huge moat with the WeChat, but it got marked down with the gaming part, which is a part of their business, especially domestically. They just have a lot of stuff, a lot of levers they can play to win in China over time. And I think Tencent's an easy way to play recovery on China over time. At some point, it won't just keep getting worse every year, right? What else is there? Teneo, that's just a little one in China. Again, that's just domestic travel. We've just seen domestic travel do well. Again, they're putting up record numbers, but they're at the cheapest valuation they've ever been at. Twilio, that was another software play. It's finally starting to come back. At some point, I'll probably get into it, but again, it's usage-based, so as software bottoms, Twilio will bottom. As use cases recover, Twilio will recover. That's pretty much the simplest way I could explain it in a short amount of time. I am trying to go quick because this video will already be super long. Advantage, so it's natural gas in Alberta. It was super cheap. They also have a cool entropy thing here, which is basically a carbon storage play. And that valuation keeps going up. So it's hard. I've been trimming it, but it's hard for me to just let go of it because I think the carbon storage business is actually undervalued in this company. It also has a very low break even. So if nat gas gets really cheap, they'll be last man standing. The balance sheet's fine, and they're buying back. I think they're buying back 7% of themselves this quarter with its cash flow. While energy has pulled back with the commodities, they are still historically cheaper than they ever have been in terms of the actual producers, which also tells you part of the viewpoints in the world on producing oil or gas. The people for the market's valuing them less and less over time. So they're able to buy back more and more themselves over time as they still have the cash flow. Though again, a part of that is I'm just worried about inventory overhang because it's been so warm so far this year. Bank of Nova Scotia. So banks in Canada have gotten very cheap. Part of that, basically rates rose very quickly, which hurt the deposit side. So banks had to pay more on their deposits. And the asset side, the loan side, resets on a leg. So as loans mature, then they can get that extra uptick from the extra interest rates. Basically, banks are the boa constrictor, and it takes time for that to constrict. And we should see that constriction continue. So margins, the NIM should improve in 2024 and 2025 for the banks. The trick here is that they also have to add credit provisions. And so we should still see more credit provisions in the early part, at least in 2024. So I'm expecting the banks to get cheaper, hopefully one more time. They are already screening cheaper. And I do know that the margins are going to improve in 2025 and 2024, right? So it's just that the credit provision side, like when I get this overreaction, oh my God, credit provisions are up, and the thing tanks, then I can be like, yes, buy. That's kind of the dream. And I could say that for all the big banks in Canada. PayPal has been a fun one. They have a transaction margin issue. Basically, they're competing with the Braintree platform, which is on-branded lower margin. Part of that is because Stripe is cheaper for a lot of people. You have pressures on Apple Pay, you have pressures on Shopify Pay. So it's becoming more commodity driven. And PayPal technically charges a premium for its PayPal checkout button. And I view that button slowly being commoditized away, so that premium might be getting eaten away. And I think that's what the market's trying to price in. It's already cheaper again than 2019 levels. The business is about 50% better than 2019 levels. So again, you're getting a business that's 50% better at a cheaper price. So that's one of the reasons why I like PayPal, but it does have its issues there, and its new CEO needs to address that. Freeport, so again, that's just a copper play. I think I did a video on that a long time ago. It's slowly trimming it down, but it's still performing well. That was the Grasberg production, and that was actually going into during the COVID crisis when copper was just selling off crazy like everything else. And all you had to do was look for the ones, again, that had a good production profile going into an eventual recovery. That was the play. IMAX. So this is one I did a video on. I just view this as an easier play to play box office reopening. This is another one that's cut in half relative to 2019 levels, but the business just put up record numbers. You might be like, how is it putting record numbers if the box office is still so bad, or say 70% of 2019 levels? It's because the business model at IMAX doesn't rely solely on box office numbers. While they help, it's not the primary driver. The quantity of movies don't matter as much to IMAX. They need just a decent quality movie every week, and you're kind of golden. And the video's there, and their maintenance part of it's also interesting, aside from just the revenue sharing at the box office. And again, people if they want to go to a movie, chances are they want the experience and they're more likely to go to IMAX. And we've seen also like the Bollywood films and local regional films do better for the local regions. And theaters are also targeting that. So they're also trying, like if they know a certain demographic lives in a certain theater, they're going to play a certain type of movie there that they may not play in a different type of theater somewhere else. So we're seeing that, and that's one of the reasons why the business is still putting up record numbers despite box office being so weak. Alright, and then another video we did was Jax. Jax is just basically the market was ignoring the fact that they're paying down debt. They had momentum from Encanto at the time. The Super Mario Bros. Movie turned out to be a bigger hit than what people were expecting. It also helped Jax Pacific out. They also have Sonic coming up. They have a good brand with Nintendo as well. So, but the crux of the matter was that I was trading at 1.5 times EV to EBITDA. Now it's at 3 times, so it's still dirt cheap, even though it's up 100%. So still holding on to most of that one. RH, just did a video on that one. That one's actually underwhelming, I think. I'm expecting sales to start getting better, but we're still seeing weakness in the real estate market. And maybe that persists until the market for real estate starts getting better, with rates coming back down, as they should over time next year and the year after. But in terms of rate of change, the market could be sniffing out that it could be bottoming as well. Maybe that's why it's up, because I actually found the last quarter to be underwhelming. Roku, we've just seen digital advertising come back, and I was lucky enough to be able to pick that up when I saw the trend. We started seeing Google and Meta and Roku, ultimately another beneficiary of digital advertising. That's actually been a fun one, because we've actually seen a pullback in media entertainment advertising. So that's like your Paramount Plus, your Disney Plus have been actually pulling back advertising relative to last year. But Roku is still able to put up numbers, and obviously you'd imagine Roku would actually be a huge beneficiary whenever those things come back online. That's not the play here. Basically the ARPU is slowly expanding. It should continue to keep expanding into 2024. Spotify is another one where it finally took price. Not only that, but some people were willing to sell it to me at 2017 prices, even though the business was already materially better. And then you had podcasts, which they're starting to monetize better as well. So that was more of an easier play to make. Obviously, these are growthier names. They're not value plays. But you have to remember, this time last year, the market was very different. It was it's crazy how much one year, how much prices can change, and how the narrative changes so quickly, and the groupthink that goes on in this space. Anyway, Algonquin, so that's utilities. I own this in 2 different accounts. Really, utilities have gotten hit pretty hard with the higher rates. Algonquin, I think I did a video on that one, so I won't go into too much detail, but there's a special reason why this one got hit harder than other utilities. and basically trying to ride the mean reversion of that, as I think they're trying to fix the critical issues there. Brookfield, this was just another one where the NAV discount in Canada was just insane. I think you're at 2 standard deviations above normal in terms of NAV discount. So, and all the headlines were just about Brookfield's properties, which is a small part of the overall Brookfield umbrella, specifically office properties and how distressed they were. And I looked through the numbers and I was like, Jesus, this thing's freaking small relative to the whole business that Brookfield represents. At one point, I should probably do a video like I did with Power on Brookfield, just because it just has a lot of things, a lot of assets all over the world. And I like their strategy though. The decarbonization, deglobalization type thing makes a lot of sense to me in the digitalization. That's where they're focusing their assets, and they had the right mindset of buying things when things are getting cheaper, and they were in a position to do just that. So I think they'll also benefit as rates start petering out, which seems to be what the market is front running, as it's gone up with the general rates coming back down in terms of the long end of the curve. E-Split already talked about. Enbridge basically already talked about. Did videos on those ones as well. Did a video on Power. Power's just again, it's another NAV discount play. I kind of lump it in with the same idea as Brookfield. Though with Power you get I'd say more insurance business, and then you also get the because of Great West Life, and then you also get a decent AUM uptick with IGM, and then you also get things like Wealthsimple in there. So that's a fun one to own over time. Superior Power, or Superior Plus, that's that's propane. That one's probably going to be disappointing this quarter. At some point, we'll actually have a cold winter, and Superior Plus will do very well. But until that point, it's probably not going to be doing too much. It pays a nice dividend to hold it, and it's relatively cheap to its long-term average as well. Again, smaller caps in Canada are generally cheap relative to the long-term average at this time. Trap got very cheap for a bit there. Coastal Gasway Link is complete. I did a video on this one. I think that's just an easier one to play over time. And I'm more interested in the nat gas pipeline after they spin off the liquids part of it. I think it's called South Bow or whatever they're calling it. Anyway, LCFS, so I already talked about Tidewater Renewables. I just think that's, again, an easy step up. You're going from 50 million EBITDA to 150 million or 160, whatever it is. It's a decent step up, and the valuation's cut in half. So you can basically triple the EBITDA, and you got half the price going into it. So that's just a nice one. Tourmaline, this is one I've started trimming as well. Again, that's just, the business is great. It's just the inventory, for my opinion, it's just the inventory is too high right now for nat gas. So I'll probably, hopefully, be able to pick it up cheaper again. Not that they're ever expensive on the current cash flow, it's just that I'm making a bet in the future. And if it doesn't, it doesn't. It's just this company is really good. Actually, they've exceeded my expectations in terms of reaching different markets and different hubs at ideal times. What else is there? AT&T. So this is one. Telecom has been getting hit for almost 2 years now, and I think this is just an easy one. It's a dirt cheap price, again, standard deviation or 2 below normal. Decent dividend. CapEx is inflecting positive. ARPU growth is positive. Net adds are positive. So the wireless side is fine, and the shrinking ICQ with the legacy voice is finally being overcome by their fiber pickup. Even on the wireline side, it's finally growing. So that's just a nice, easy free cash flow positive rate of change play for 2024. Polaris, so recently trimmed that one. Basically, the business is performing great. They did a step change. They basically removed $100 million out of their expense structure in terms of leases, and that's never come back. So basically, their floor is $4 earnings power, and so it still trades very cheap, get on 8 times, and they'll just continue to slowly pay down debt and give me value over time. Coles, I think I already talked about, but yeah, I own that one. Again, the land value there is just amazing, and then you get the uptick over time as eventually sales bottom out. I'm surprised that it's relatively much it has. Part of that's probably the Macy's, which I recently sold because of that takeover bid, likely for the property value. So again, the retail is tricky because I'm kind of expecting more pain, but at the same time, I can't really wait for it, right? Especially when they're already at 2 standard deviations cheaper and have been cheap for 2.5 years, kind of thing. It's just like at some point you got to start pulling a trigger on some of these. Maybe they get cheaper again one more time. I'm kind of hoping that's what happens, but you need to try to cover all your bases in case it doesn't, and they just run off like they kind of already have. What else is there? Paramount. So this is a fun one. Been down for 2 years now, and I've started to add to this one as well. It's just basically digital. We saw digital advertising come back, but linear never did. Normally it does, but it didn't this year. It's actually gotten worse as the year went on. For example, Q1 2023 was -8%. Q4 2023, or sorry, Q3, because we haven't seen Q4 yet. Q3 2023 was down 14% year over year in linear advertising. So that's always, I shouldn't say always, but the trend has been declining for linear for a while. With viewership going to online. That's one of the reasons why all these companies have gone for their own streaming platforms. And it's also one of the reasons why we're likely to see consolidation, as the margins aren't the same as their cable networks or legacy business is. So why own it, right? Well, one of the things that it's got destroyed. And two, I think the value's there. It's just hard to time it. So this is one I'll probably do a video on again at some point. But for example, I think next year is very hard to do worse than this year. Does that make sense? There's a couple of reasons why. So I think next quarter will be kind of mixed because you're still going to have the shit quarter for Q4. And then in Q1, you're going to have the Super Bowl. That's on Paramount or CBS this year. Then you have the Showtime $700 million acquisition cost savings. They're tucking it in. So they'll save that on the studio expense side. And then you have the fact that they're finally increasing price like the other guys already have, which is finally starting to show up in the numbers. So that should increase ARPU about 20%. And then you have the political in the back half of 2024. So you have a decent amount of things on top of, say, trading at 7 times this year's earnings potential, latest quarter anyway. And that's in a quarter where your legacy business is down 14% year over year, and you're still losing $300 million on your DTC business. So you're getting, I'd argue, a decent shot at this time for Paramount. That's a fun one. The bonds starting to come back a bit. I got a little bit too excited with that one. But long term, the bonds, that's just a way to hedge things. If things ever go really bad really quick, that'll be the one that I can just sell and buy one of these probably dirt cheap retailers if things get that bad. But that's kind of like it's kind of like I treat it like cash, really. But it's one of the ways that I'd see more appreciation if things got really bad really quick. Stone Co, this is just an easy one in Brazil. We did a video on this one as well. I've already taken some proceeds out of that one. The whole point there is that it's really interest rate game. So they borrow their costs that's kind of floating, and then they kind of slowly increase their rates to the end user over time. So they lagged the inflation on the way up, and as rates start coming down, their borrowing actually gets cheaper. So they should see margins expand, which they are, which is what the market's finally picking up on. And that should continue all the way back down. And then competition, and then we'll slowly lower the prices on a leg. So they should actually see margin expansion for this whole deflationary cycle in Brazil. Or disinflationary, not deflationary cycle in Brazil. So that's what I'm thinking. Software business is doing better than I thought. And they're finally, they are starting to go back into credit lending again, which I'm nervous about. The market obviously likes it, but I'm still worried about it. So that's something I'm going to keep looking at every call. Uber has done better than I expected. We knew there was going to be the reopening play, and that was half the move. And I think the other half is that mobility is still comp to comp. So 2022 summer was very strong because of the reopening play. In 2023, comp to comp mobility was up 30% over 2022. So very strong numbers. A part of that, I think, is Uber scales well internationally for airports. Probably more than I was expecting. So keeping with it for now. It is also affected positive in terms of business, cash flow, profitability. And its investments in like Grab and DD are finally no longer getting destroyed year over year. So things are starting to bottom there. Ultimately, it's probably one of the more expensive names I own at this point, Uber. Algonquin I talked about, I own in 2 different accounts. Google, digital advertising. Just, it was one of the ones I picked up last year where things got dirt cheap. I think it also got dirt cheap when ChatGPT and OpenAI were released. And people are like, oh, it's the end of Google. And I sit there like, oh yeah. And then you look at the numbers and it's just like, yep, sick rebound in digital advertising. YouTube's just destroying it. And you have Google Cloud, which is so much in backlog still. So I don't know. I just view Google as an easy way to play AI for a place that's way underappreciated. They just think it's going to be displaced somehow when they have the best engineers in the world in them. ATCO, again, defensive utility play in Canada. We have the PBR reset cycle. That's finally getting through. So this should be the last quarter of year-over-year declines on the utility side. In terms of the ATCO side, the businesses are all performing well. Structures is performing. Ports is performing. And we just got a better ROE allowed in Alberta. And actually one that I think is a tiered structure, which will be more fair. Actually rewards ATCO better in the long run than it has in the past. So we should start seeing that utility finally start doing better than it has in the past relative to other utilities that trade in Canada. Or at least that's what I would argue based on all available information. Bank of Montreal, different than Bank of Nova Scotia, but aside from Bank of Nova Scotia, which is now finally going to start prioritizing Canada and pulling back a little bit from Colombia and Chile and Peru and focus more on North America, so Mexico and Canada specifically. Bank of Montreal is a cool thing where they're actually, they bought an American bank called Bank of the West, and they still have to harvest quite a bit of synergies off that. At the end of the day, the trade, I think they're going to trade similarly, and I kind of already talked about how I view the NIM expansion versus the increase in credit provisions that we should see in 2024. REITs have been getting killed for a while, so H&R REIT is just an easy way to play that. The NAV discount, basically you get $3 billion worth of property value for, what, $1 billion? Or $1 billion off, rather. It screams dirt cheap. A part of that, I think, is its office exposure, but again, its office exposure, they've continued to sell down its office at prices that are higher than their carrying value on the books. So I just view this one as an easy interest rate proxy play over time. REITmans, I already talked about on that one again. Suncor, I did a video on a long time ago. New CEO finally starting to lower the break evens and get Fort Hills operating as much as it should. The thing that sucks here is that we're seeing the CapEx start to creep up in Canada again. They're all chasing prices higher. So we're actually seeing CapEx start to go back up to 2017, 2018 levels, which is not what you want to see. Because again, the commodity is going to drive the share price. So we might be getting a little bit long in the tooth for a little boom bust cycle on oil. But we'll see. I'm kind of playing that between Air Canada and Suncor. I'll probably just keep trading on and off both of them, right? As Suncor goes to 5 times and Air Canada trades down to 3 times, I'll probably rotate from Suncor to Air Canada. That's just me thinking out loud. Telus already talked about. I own that one in 2 different accounts. Airbnb already talked about that one in 2 different accounts. Expedia, just in my mind, it's just very cheap still. I know it's gone up quite a bit. They're finally got all their tech stack in a row, so we'll see what they can do. But in terms of the historical averages, it still trades very cheap relative to what it has, and the recent downloads look strong for Expedia on the App Store. So that's just that. IDV is just an easy way to get dividend income in Europe, so it's kind of unique that way relative to all my other holdings. Just a way to get diversified income to continue to add to other things as things get cheaper. PayPal already talked about, and then Spirit already talked about. So yeah, that's all the positions. I tried to get them done under an hour, which I did this time, so exciting. All right, but yeah, have a happy new year. I'll probably get back to doing things next year with a normal video, but I like to listen to myself think for these videos when they're so quick. It's kind of ultra rapid fire. You're just going through so many names, and I don't know what I'm going to say on each of them until I start talking about them. So it kind of helps me know what I'm thinking at that time and what I'm missing. So inevitably, some of these I should have been selling right now, I'm pretty sure. But I don't know which one, right? I don't know how much more expensive they're going to get, right? But overall, 2023 was a strong year. Honestly, all these last years have been fairly strong. COVID has allowed, I think, opportunities more than I ever thought they would. But anyway, have a great rest of your weekend, and Happy New Year.